today's topic, we're going to discuss moving averages. This is the most popular technical system out there. Most people are using it from institutional and retail perspective. So we're going to go through this system in detail. We're going to talk about the strengths. We're going to talk about the weaknesses too. And we're going to do a couple of PowerPoints, not much, just to kind of explain the definition. But my goal is to pretty much teach you from live charts. We also will use the MACD indicator too, moving average divergence indicator, and for determining divergence, convergence, and stuff like that. And I'll talk more about that when we get there. But I'm sure everyone's probably heard of moving averages, and so forth. You're probably using it today, but I want to go through it in great detail too. And I'll give you an institutional perspective too on how they're using it, what they're doing, and so forth. Okay. If you don't know me already, you can find me here. Pretty much, I was a retail trader that turned professional, 16 years in telecom, and then pretty much went to Badge Money due to a track record. Worked in Wall Street for over 4 years, creating machines that did high frequency trading and so forth. I'm a pure technical trader, not a fundamental trader at all. I believe in timing. Today, I manage my own money and go around the world helping people turn that corner from retail to becoming institutional trader. So that's a summary of me, but really that doesn't matter. Okay, so let's go through. Before we go through moving averages, I really want to talk high level. We've been talking about various different systems out there. We've done a workshop on real bars, fake bars. We've done a workshop on Fibonacci. We've done a workshop on Elliott wave and everything. If you look at the most common thing, the sole job of an indicator is to provide you two things. One is the support levels, one is the resistance levels. Trading is all about finding these key support resistance levels and then placing your orders around those levels. You could place orders to break those levels, or you could place orders to bounce off those levels. The closer your entry to those levels is, the lower the risk and the more the reward you could get. And so that is the overall high level idea of what an indicator's job is. Okay. So it's supposed to give you all these levels where you know where you could buy or sell at those particular levels. So I want to make sure that everyone understands support resistance. Resistance is basically where price is going higher, 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 higher. It means bullish. And then all of a sudden it runs into obstacle. And a lot of people call it a theory. It's called a resistance and so forth. Support is the opposite side of that, where price is going to go down, 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 and then runs into a floor where it could stop, it could reverse, or it could break it, depending on how things are. So this is the high level definition of support resistance, which is a sole job of an indicator to do. Okay. So now let's look at moving averages. So if you look at moving averages, it's the most popular technical system out there. Um, if you Google search it, you'll see it's a lot of information out there on moving averages. You'll see a lot of custom indicators on there. They're varying the different periods for the indicator. There's a lot of customization in there. There's tons of things out there. Reason why is this the most popular system out there. So that's the most marketed system too. So you have to be very careful in what you do and how you use it. And that's one of the things we're going to go through today is we're going to discuss the parameters for the indicator, how to use it, whether you use a simplified moving average indicator, the moving average, use the exponential and so forth, because it really, really can get complicated. And remember, your goal is to keep things simple. Okay. If they're simple, now you could trade probabilities. If it's complex, you're never going to be able to trade the probabilities and you'll never be consistently profitable at all. So you want to keep things simple and learn how to use those simple methods, not try to do anything complicated at all. And that's the goal for today. And that's what we're going to show you how to do that. And I'm going to share you my experience with moving averages on how to make it work moving forward. Okay. And if you have any questions, feel free to ask in the chat. You could also unmute your microphone too and ask us too. Okay. As I mentioned, retail people use this a lot. Institutions use this indicator a lot too. So in the institutional world, you may not know it, but a lot of institutions use this, or they actually start using Ichimoku, which is going to be the next topic, the next month, and that's actually my specialty too. But these are the two systems that basically institutions use to determine when to buy, when to sell, and then they take over with their money management skills from that point on. Okay. So the key thing here is the formula is based on closing price. And that's the thing you have to understand. And I'm going to go for this in great detail. The moving average is based on closing price. It's not based on the high or low or at all. It's not based on the opening price. It's based on the closing price. So the moving average indicator, the lines in the indicator will only move once the closing price is finished. Okay. So once the closing price is done, the bar is closed, then the indicator can adjust and move. And that's critical to know. The reason why is if you're trading moving average indicators, a lot of people call it a delayed indicator because you have to wait for price to close. And a lot of times you're going to give up some of the reward when that happens. Okay. So a lot of people don't like moving average indicators because it's a lagging indicator and you have to give up some of the reward. However, you can work around that. Okay. And with your money management, and we're going to show you how to do that today. So that is a weakness for moving average indicators, but there's ways to work around it, and that's what we're going to discuss. The good thing about moving average indicators is that it's simple. It's a simple concept out there. It's very easy to use, and that's why a lot of people gravitate towards it, right? And we've already gone through Elliott wave. That's very complex. Fibonacci, you have to determine where to draw from where to where. That's very complex too. This is probably the most simplest system out there to use, even though it has some negativity to it, but it's very simple. And that says a lot to it. Okay. And remember, there's no indicator that's perfect at all. It's a yin and yang. We're going to have strengths and weaknesses in there. The key is to recognize the strengths and weaknesses and deal with the weaknesses with your trading plan. And that's what we're going to deal with today. Okay. Definition. So if you look at the definition, moving average, okay, we're established that the moving average indicator is based on closing price. And if you look at the terminology in the indicators, it's moving average. So your goal is to take the average of the closing prices for X periods. Okay. So for example, if you use a moving average indicator for 10 periods, it's going to take every bar the closing price for 10 bars, take those closing prices, add them up together, and divide by 10. And that's pretty much going to give your average, the values to that moving average indicator. So it takes the average of all the closing prices for the last X periods. And the periods is determined on what you want it to be. I'm going to discuss the periods that institutions and a lot of retail traders use today from both a day trading perspective and also a long-term perspective. Okay. So we'll go through those in just a minute. And in fact, what we'll do is we'll go to silver, the most volatile metal right now. And we'll talk about the silver. We'll pull up that chart with silver. We'll pull up and use moving average indicators there. So I'll show you how the moving average indicators look with silver right now, especially with that big down move last week. And I'll give you a perspective on what institutions are thinking and so forth going forward. Okay. But this pretty much gives you an idea of what the formula is. Okay. The most popular moving average indicators, if you look at the bottom left-hand corner, are the 10 and 30. So a lot of day traders use the 10 and 30 a lot. Okay. So they use a 10-day moving average, 10 period moving average, a 30 period moving average. And then the institutions love to use 50 and 200 period moving averages, which are more long term, which gives you a longer perspective and stuff like that. And in fact, the 200 is the most popular out there. That's kind of like the borderline condition between something being bullish or being bearish. So that tells you your long-term perspective there. Okay. So this gives you a definition on moving averages and so forth. Is there any questions before we start going to live charts? No? Okay. So let me quickly stop sharing and give me a second. And I'm going to pull up the live charts now for you. Okay. Can everyone see my screen? Okay. I'm assuming yes. Can someone type in the chat room if you could see my screen? The chart. Okay. So this is silver, as you guys know. This is the daily time frame here. If you have not used this is in TradingView, of course you could do the same thing in MetaTrader 4 or 5 too. But I like using TradingView. So we're just going to do that. Here you could just go in and you look at here to add the indicator in here. So if you just come in here, oops, let me just expand the screen so I could see more. Just come in indicators here, go to technicals, indicators, and look for basically SMA. Now we're going to use a simplified moving average. There's also other types of moving average. The other popular one is exponential, but we're just going to keep this simple and learn how to work with the most simplest concepts out there. Okay, so that's a simple moving average. If you go into the parameters here, you could see that you could go in and choose the length, which is the period, how many bars in the calculation it's going to use. So the SMA here is going to use 10 bars for the average. And then if you look here on the top left-hand corner, we are looking at the daily time frame. So this SMA 10 is going to take the closing price for every day for 10 days and then average that out. And that's the value you're going to get. Okay. And right now, we just chose this randomly. You could choose the cards you want. The 10 period simple moving average is going to be blue. Okay. And then if you look here, the 30-day here, you just go in and just change the parameters here, and it's going to be red. So you're going to see the red there as the 30 period moving average. If you come in here, I'm going to bring in the 50 period moving average. That's going to be green. Okay. And then the long term, which a lot of institutions use, is basically going to be the 200 period moving average, which is the purple here. Okay. So if you look here, this is the 10, 30, 50, 200 period moving averages. And those are the incremental. So of course, the 10 period moving average is going to be closer to price compared to the 30, 50, and so forth. Okay. Because it's how long of an average takes. And you could see here, the 200 is way down there. Okay. Now, right now, I'm just going to sit there and choose the 10 and 30 to kind of show you how the system works and so forth from there. Okay. So I'm just going to enlarge this here right about here. Okay. And way you look at the system is that when the 10 period SMA is above the 30 period SMA, in other words, when this line here, this blue line here is above the red line, that means basically the instrument is bullish. Okay. If this blue line here, the 10 was below the 30, then that means it's bearish. Okay. So that's the simple crossover here. So you're looking for these systems here, and you could see here that blue is above the red here. And basically at that point, this is bullish. Now, in order to take this one step further, you also want price to be above the blue line. So when you have price above the blue line and the 10 is above the 30, that's now bullish. So here, let me just make sure you understand this. So bullish sentiment is basically when price is above the 10 SMA, which is basically in blue, okay? And then you want the 10 SMA blue above, okay, the 30 SMA red. So if you have that, that basically gives you a bullish sentiment, okay? The bearish, of course, is going to be the opposite, okay? So I'm just going to give you that right down here. And just change this real fast. Okay. And this is the bearish side here. And I'm just going to color it red. That way you kind of see it there. It's a little different there. So this is the sentiment here. And you could see here, once price got above the blue line right there, this is basically where the sentiment changed here. So if you look at this scenario here, price here, the closing price was below the blue line, between the blue line and red line here. And this is the first time here after it did that, it changed states to being bullish here. And let's zoom in here. That way you could see this even more here. Okay. And I'm going to do this here so that we have all this here. So this is the first time here that you went from a neutral state here to a bullish state. And because price here was between the blue line and red line, so it's neutral, even though it's bullish. So we call it bullish consolidating. And we say bullish consolidating, reason why is the blue is above the red. So that said it's bullish, but price is not above the blue. So it's bullish consolidating when it's doing this scenario here. This is when it went into a bullish trending scenario where price now is above the blue line. It's above, and the blue line is above the red line. So this is the first time here it went bullish. Okay. And now what you do is you want to make sure that the price stays above the blue line and also the blue and the red remain the same. So in other words, this state here remains. If any one of these rules become true, false, now you need to exit the system. So this is the first time it went bullish here. So really what you could do is you wait for this here to, you could enter on this next bar. Some people like to forecast and just go ahead and jump in. I will really not recommend to do that at all. I would recommend to go on the second bar here, right there, and enter on this bar here. Okay. So I would do that here. You wait for the bar to change from one state to another. And then you would enter, once you see that, which is here, then you enter here. And I would do a breakout order here. So a couple of points above that high, you would look to enter there. Okay. And then what you do is whichever bar that broke the SMA right there, I would use that inner bar low as your stop. Okay. So I would come in here. Oops. Let me shrink this down some. Right there. And use that right there. So I look to enter in here and go in here. Most people would use the previous bar, this bar here, low as your stop right there. So that's your risk here going into this trade. Remember, this is a daily time frame here. So your risk is going to be about $1.83. And then if you map out where 3 to 1 is, that's about right here. And remember, we talked about this in our money management workshop that you want to make sure you get to 3 to 1 and then protect your profits there. The 3 to 1 is roughly, it's just about right there. And here, I would really recommend taking 50 to 75% of your positions off and going to break even or start using the trailing stop. Okay. So this is how you would enter silver here. And you would have entered here November 25th on the daily time frame. Daily is longer term. Remember, everything we talk about can be used on any time frame. So you can use this on a 5, 10, 15, 30. It does not matter at all. Okay. So here I would recommend you take some profit off and then at least move your stop to break even so you do not give back your profits. Then start using a trailing stop. Some people, what they do is they just use the blue line because it's closer to price as a trailing stop. So they use a buffer below the blue line as a trailing stop. Some people wait for it to close below the blue line for the trailing stop. So if you look here and you used it here, a couple points below the blue line here, you pretty much would get out of the trade roughly about right there. So you would have declared a 25 to 1 reward risk ratio on silver on this particular entry right there. Okay. Now that gives you a nice little picture that you could sit there and look at. Okay. How can you optimize? Well, we've gone for our workshop series and we talk about real bars and fake bars. Okay. And I would use that concept here, especially when you break the moving average here. A lot of times you could get some false breaks, and that typically will give you false signals and you're going to enter them wrong. So I would make sure that this bar here that closed above the 10-day SMA is real. If it's not real, I would not count it at all. In this scenario, it was real here. And then I would make sure my entry bar, it's real too. If it's not, then I would walk away from it here. So in both the scenarios here, this is the real bar. And if I just put in the real bar, fake bars, you can kind of see here, the bars not in color are fake. Okay. So you could see here that when we did break the SMA here, it was a real bar. So we got a real signal and then we entered here, that was real. So now I increase my probabilities by using the real bar, fake bar concept that we went through. Okay. So that's how we'll optimize the simple moving average is through the real bar, fake bar concept that we went through in the previous workshop. If you don't know what that is, you can in this Telegram chat room, you can reference, we go back to the video on that, and that should help you out drastically. Okay. Now let's go backwards in time and kind of show you where it could fail. Okay. And go through there. So here's a scenario here. Price here, we're kind of flirting around here, the blue line and the red line here. Okay. And you could see here, we came and touched the red line here, and then we bounced off it and so forth. So the one-way system, the one way of trading moving averages is to make sure you change states, either the blue line, red line cross, or price now went from being neutral from a consolidation period to be neutral. We showed you that. Okay. The other way a lot of people trade this is that when it goes up, then it comes back, they look at the lower one. So if they're using 10 and 30, they're looking at it hitting the 30-day moving average, which is right there. And then they're looking to see, looking to buy. So a lot of people, when this hit here, right here, they're looking to pretty much buy this particular instrument. So they're going to look to enter many different ways. One is they may sit there and buy as soon as it breaks the previous bar high. So if they did that, you're going to look here, it never did. But over here, you would sit there and buy right there, and you would buy here, and you would enter this trade here. So the moment it closes above the previous bar high, after holding the lower level of the moving average, they would look to buy. So they would look to buy here, right there, and then they would use various different stops. Some people would use the bottom of the blue line minus the buffer as a stop. Some people use the red line minus the buffer with a stop, depending on if they're long term or short term. Okay. If you're buying up this level, my recommendation is if you're buying up a bounce where you're not really changing sentiments at all, you're buying up a bounce, I would keep your stop very, very tight because this is more of a trend continuation where I would use the blue line as my stop here. So if you look at that scenario here, I would enter here and this bar here, I would exit out because it got below the blue line by a couple of points. If you use the red line here, you would get stopped out here. So for trend continuations, I definitely would sit there and use the blue line, the shorter term moving average as your trailing stop compared to the longer term, which is the red line, which is 30-day. Okay. I'm giving you various different scenarios to look at. I honestly prefer the changing of the states. I really don't like the idea of you bounce up a level and then looking to enter there at all. If you do that, then you're going to have more risk. I like the changing of the states where you went from one state to another state. So we could go from bullish consolidation to bullish trending, or you could go from bearish to bullish and various different things like that. Okay. So my preference still is this scenario here when you broke it there, not bouncing off a level here. Okay. So that's my preference there. And I think you'll be more successful if you do it this way, not dealing with the bouncing effect. Um, the other thing a lot of people do is where they look for a crossover. So here you could see that the bar is above the red line. Okay. And remember, to be bullish sentiment, the blue has to be above the red. You don't have that. So even though the price is above the blue line, you still don't have the blue line above the red at all. So this is not bullish at all. Since the blue is below the red, this is bearish. And now that you have price above the red line, it's bearish consolidating. Okay. So this is bearish consolidating, believe it or not, here, bearish consolidating, bearish consolidating. And then all of a sudden, right here, this is when everything changed. Okay. So this is when the blue line got above the red line here. And now and price is above the blue line too. This is the moment where you went from bearish consolidating to being bullish here. Okay. So this is bullish trending here now. Doesn't mean it's ready to go up. It's bullish trending here. Okay. So once the sentiment changes here, a lot of people start looking for bullish trades. They may just enter right away. They may wait till it comes to the red line and blue line here. If it does, then enter. Or they may buy above the previous bar high. Many different techniques are used there. Okay. I personally wanted to change. I like the scenario where price gets between the red and the blue and then breaks out. I wanted to break a blue line or a red line to enter. So that's the way I like to enter. I really don't like the idea of bouncing off things here. So again, even though the sentiment changed here to being bullish, so if you look here, this is bullish trend right here, because that's when everything became there. And over here, this is basically bearish because the blue line is below the red, but you really don't have a scenario of price being below the red at all, below the blue. So we're just going to say bullish consolidation, okay, and just label it to be that right here. So these are different states right there, okay. And then notice this is bullish trend, but it didn't break a red line, a green line at all. Okay. So over here, right here is basically where it went bullish. And just for screen, ah, okay, this does not want to work with me. Let's do this. Okay. I'm just going to say it's bearish C for consolidation, so it doesn't take up the whole screen here. Okay. And then over here, this is bullish C right there. And then it goes to here, a bullish trend. Ah, things are not cooperating. Okay, it's looks she's getting this. There we go. Okay, so this is pretty much right here is where I like it. Okay, so if you look at this scenario here, the best states, the best trades, believe it or not, okay, is where you go from basically a bullish consolidation to a bullish trend. And the reason why is you're breaking a red line, a green line, you're not really bouncing off it. Okay. So it's proof. And then also you're going from a consolidation state to a trending state, which is a lot better. Okay. I really don't like this scenario of a bearish C, a bearish consolidation could go to bullish at all. Even though you're breaking it, you still have various different things that have to happen. And what typically happens is when you go from one state to another, like a bearish state to a bullish state, you typically go for a pullback. And if the pullback is too much, now what's going to happen is that you could sit there and lose. So I really don't like that at all. I like the states to be in the same before they transition. And that's why I like it to go from a consolidation state to a trending state. So this is really the best scenario I like here and here. And here, I'll just put it here too. So I like it to be bearish consolidation to bear and breaking a SMA. Okay, so those are pretty much right here, everything we're looking at here, uh, going forward here. Okay, so this is what I really, really like, and I think works really well. Again, if you go from one state to the other state, you still could go for a pullback, which you did here, and that pullback could actually just get destroyed. In some scenarios, it actually gets below the red line here, and you enter a consolidation state here, which is not a good scenario at all. Okay, so the best states is basically when you go from consolidation you're trending in the same state, like bullish or bearish. Okay. And I really don't like the idea of bouncing off these levels here. If you do a bounce, then I want the bounce to be where price is basically here. I don't like the bounce here because price is what's above the blue line. I like the bounce here because price is below the blue line. And now it has to break the blue line in order to start a trend. Okay. Any questions in regards to that? No? Okay. And what I'll do is I'll also paste this in the chat room right now and the Telegram chat room. So you have this to reference to also. So just bear with me a second. I'm just opening up Telegram and I'm making sure that's in there. Okay. So you have this for reference material. That way, if I delete it in a minute, you still have that information here. Okay. So this shows you exactly how to do it here. Let's go scroll back. Let's look back here. You could see here, this is a scenario that a lot of people like to enter. I don't. And you could see here, this was the blue was still below the red. This is the first time when the blue got above the red here. Okay. And you could see here, this is where the blue got above the red here. So this is basically when it went into a bullish trending state right there. Okay. And as I mentioned, when you go from bearish state to bullish state here, they could go for a pullback. And that's exactly what it did here. It did a pullback here. Okay. And it did, price did not close between the red and blue, green line, sorry, the blue and the red here at all. So this is not the ideal setup at all. Okay. If you do want to trade this type of scenario here, what I would do is that when you change from bearish state to bullish state, look where the pivot is. So this is when the state changed here. Find the last pivot. So that's the pivot right here. Okay. And once you find that, now your goal is to break it here. So don't look at buying here because it could come down and you could get caught in consolidation pattern. I will look to buy here. Okay. So this here bar here, if you look at the closing price here, that's 39.049, 39 here. So this here actually closed above this level here. So you could buy here and then whatever bar that broke the pivot high here, I would use that low as a stop there. So you could enter this position here. Okay. Here, right there. And of course, you want to make sure this is the real bar here. And I'll always, if you get another two real bars in a row, remember you start a trend. So you want the two bars to be in a row, otherwise it can consolidate and come back. This was real, that was real, started the trend, got you your price away from the entry. So there's low probability you're going to get to your stop here. And you could see that you could enter this trade here completely there. Okay. So if you come back to everything we talked about here, okay, and I'll do it here. So if you look in this scenario here, second best trade is basically where you went from bearish consolidation to being a bullish trend. And now what you're doing is you want to break the last pivot high. Okay. And that literally is how you could trade the bounce. So you transition from one state to the other, but now what happens is it could go for a pullback, but you're looking to enter after it does the pullback and then breaks that last pivot high, and that will give you a very high probability of success. And remember, if you want to optimize things, you want to make sure that when you break the SMA or to break the pivot, you have two real bars in a row. If you don't have that, then then it could consolidate and it could come back to your entry and you could get stopped out at that point. Okay. So that should complete everything here. And let's shrink this down. Okay. And let me just put this over here, I'll just put that there. And you could see this was the one entry here. So I'll just put the reward risk over here so you guys could see that. So you could see the various points that you could enter on a lot of these here. And this kept on going to roughly about right there. Okay. If you look at the bearish transition here to here, the other entry point, remember, if you look at this here, the pivot was right there. So that's the other entry point right there, which would be here. So if you go off the second strategy where you went from bearish to bullish, the pivot's right there and it broke it right there. So that's the second, that would be the entry based on the transition from being bearish to bullish. But you could see here that if you got in between the red and the blue, that gives you a better entry compared to there. So this is why I like this the most, is because your risk is the lowest in the best trade strategy compared to the second. Okay. So that gives you an idea of how to use the moving averages indicators in its simplest form without getting into the exponential, the customization, or any of that stuff at all. It's showing you how to use this in a short, simple method. A lot of little concepts, right? And you remember, if you take the things off of balance, a regular balance like here, then you don't have a high probability. The only way you have a high probability is to make sure you break a pivot. Okay. And a lot of people don't use that concept of waiting to break a pivot at all. They want to go in as soon as you hit that red line here, they're ready to buy because the risk is low. But even though your risk is low, you have a high probability that this thing could consolidate for the longest time and you could get stopped out a couple of times. So that really doesn't help you, especially from a psychological point of view. Even though the stops are very small, you're going to take a lot of hits if this thing consolidates. And at that point, it's really going to dent your emotions. And it's from a psychological point of view, you're not going to become a successful trader at all. So if you stick to these two methods here, you got a higher probability of success. Okay. The other thing I wanted to bring in here is, okay, let's see. Oops. Okay. So here's the MACD. Some of you guys have seen the MACD and everything. People reference this for divergence and stuff like that. So I wanted to bring that in here too and kind of discuss this here. Okay. The MACDs here, you can see here, this is the MACD. I'm just using the basic parameters and not going to modify it at all. Okay. I'm going to delete some of the stuff we have going on here. That way the charts don't look busy. But the goal here is not to look at this here. There's a lot of complication here. I really would recommend that you just delete everything. Just keep the histogram there. Okay. So I would just keep that histogram there. And your goal here is to look at the histogram and look for divergence. Okay. And what do I mean by that? Okay. So if you look at silver here and look at here at this point here, okay, this was where it registered a high, right around here. And if you look here, the value of this histogram here and over here or right here, you look at it here and it says 0.68. Okay. When you retest it here, this value is smaller than that. Okay. So let's put these little arrows there just so that you could see it here. The highest point here was right there. Okay. This is the second highest here, right here. Okay. And if you look at it here, right, it went down. That's not good. Okay. So this tells you that when you retested that high, this here is going down. Okay. That's not good. That's called divergence. And there's high probability when you get this divergence, when you test this here, if this level is a lot lower than this, then you got a high probability that this could be a double top and things can reverse. Okay. And that becomes dangerous. The next time it came up to here was here. Okay. Right about here. Right here. Right there. Okay. So this level here, if you look at it here, a lot of people, what they do is they'll compare it to here, and it still looks like divergence. And that's the wrong thing to do, believe it or not. So every time it retests this level here, I really look at things to retest. Okay. So for me, I'm looking at this level here compared to the last retest right there. And that actually shows you if you did that, now what happens is you're a lot higher. Okay. And now you can start a trend and this goes up. But most people compare this level here to here to a point it still looks like divergence. And at that point, it looks like it's not going to keep on going up. Yes, in hindsight, this looks great here. But if there was another divergence after the bar broke this level here, if this level here was not higher than the previous level, this thing could come crashing down and that would be a fake move. So I would always look at this level here compared to the previous time it tested it and look at the divergence, not look at it to the very, very first time right there and go from there. Okay. That's the number one mistake I see a lot of retail traders doing when they sit there and bring in this MACD for divergence, convergence, and stuff like that. Okay. So you could see here that you were going up. Of course, when you look here at this level here, when we're looking to buy here, this is not high at all. Okay. So when you're looking at when you're breaking pivot highs and stuff like that, that's when you look at the divergence there. If you're looking at the transition between bullish consolidating and bearish consolidating, not retesting the high, but more towards here right there. Okay. What you want to do is we're looking to enter on the second bar here, which is right there. And if you look here, right here, this was still red, which is not a good scenario. When you enter and you're going bullish, you want this to be blue, to be green. If you're going bearish, you want it to be red. Now, this was here just barely at the zero line, it was barely red here. So this is why you always look for two real bearish, bullish real bars in a row, because it helps you confirm and helps you get past these little transition states, which may be borderline conditions. And since this bar was real too, look what happened. It changed from being barely negative to being bullish, which is exactly what you need. Okay. And that was a very good scenario here going forward. Okay. Now, it's a lot of little information I'm going through. Remember, for the recordings, you could kind of go through it and see all that stuff there. Okay. So lastly, now let's bring in all of them. Okay. So the 10 and the 30 are used for short-term trading when things are in trend. Remember how we talked about in the Fibonacci that a real trend is where it continuously keeps on retracing the 38.2 back and forth, back and forth, back and forth. So what the way the institutions look at things is that short-term Fibonacci of like the 38.2, where it pulls back, which are healthy pullbacks, is where it continues to keep on pulling back to the 30 SMA, bounces off that, and keeps on going. It really doesn't get down to the 50 to the 200-day moving average at all. Okay. So when it bounces off the 30-day, that's what we call a short-term small minor pullback. Okay. If it bounces off the 50, that's basically called a medium pullback. If it bounces off the 200, that's called a major pullback. Okay. So if you look at the big drop that silver had right there, it basically got to the 50 SMA here. And now what's happening is that this here is a medium pullback. Okay. It's no longer small pullbacks, which were to the blue or the red. It's now at the medium here. And if you notice, it stopped exactly at the 50 SMA. Okay. Now that it has to get above this red, the 30 SMA here by the end of today. If it doesn't, it could hold this level here because this is a support resistance. Remember, each one of these lines of support resistances, so silver is at a very, very critical level today where it has to get above this level here and form a real bar. Remember, if it doesn't do a real bar, it's a fake break. So today is very, very critical for silver. And if it does break it here and does a real bar today, and then you get another one tomorrow, you got a high probability you're going to retest this high here. And the only obstacle you're going to have is this 10 period SMA right there. Okay. But this is at a critical stage because you're bouncing off this level here. And if you could break this red line today, now you've got the best ideal strategy, which we talk about going forward. But notice one thing, you break the red line here. Now what happens is you have a negative divergence here. And you really want to see this red here to start moving upwards. So when you deal with a 10 and 30, you're looking for this divergence to be positive. When you start getting down to the 50 SMA, this is not going to be bullish at all. What you need to do is see these red bars to start to move up where you're trying to get closer to the zero line here. So when you start pulling back to the 50 and the 200 moving averages, you really can't use divergence that much. And reason why is it's gone through a medium to a major pullback and not trending anymore. They're going from medium to major pullbacks where the divergence indicator really does not help you that much. Okay. I think I've covered majority of everything here um, in the moving averages. We talk about the definition. We talk about the highest probability strategy, which is going from bullish consolidation to being bullish trend. Then we talked about the second highest probability, which is going from a bearish consolidation to a bullish trend, and then keying off the pivot. In either scenario, when you break the SMA or break the pivot, you want to make sure that you have a real bullish bar or bearish bar and to entry and to stay in it, and then also one after that to confirm it in order to increase your probability of success. If you look at the MACD, you could use it by divergence, but use it, especially on the pivot side. When the second strategy is where you use that a lot, the divergence, and you mainly use it a lot for the short-term moving averages like the 10 and 30. Because if you look at it for the long-term moving averages like the 50 and 200, typically the divergence is the opposite color compared to which you're going. So the only thing to do is when you bounce off these long-term moving averages, start to see this divergence start to go more up and start going towards the zero value than being above the zero value. That's it for today. Any questions? Does anyone have any questions? No? Okay. We're actually going to start this month now, um, start looking at Ichimoku. So that's going to be our next transition now. We're going to probably have 2, 3 separate workshops for Ichimoku, break it down and stuff like that. As you know, Ichimoku is my specialty and what I love the most, and you're going to see exactly why when we do that. So we're going to go for Ichimoku in great detail. We'll first workshop, we'll go for the formulas, go for the details, determine how to know the sediment. Then the second workshop, we'll go for the various different strategies that are out there. Third workshop, we'll go through and show you how you can find institutional support resistances, go for a thing called time frame matching, which no one really does or no one knows. So I'm going to give you that inside secret how to do that, and then and then we'll see where we're at with everything. Again, let me show you this. Give me 1 second. Sure. Please, at the top right-hand corner, there's the Telegram chat room. Please pass it to your friends and everyone too. Get them to join. Like the group to get bigger and bigger. That way we can sit there and do various different presentations, have more questions and stuff like that. We will post the recording soon as it's available. So stay on the lookout for that recording. But in the meantime, if you have any questions, feel free to ask in the chat room. Okay. Thank you and have a good day.